So I'm going to do a quick intro just to kind of recap folks on what we last talked about and what we're picking up on today. So welcome everyone to our series. This is about self-directed IRAs. There's about a couple parts to these because this is actually really a lot of intense information that we wanted to make it more bite-sized. So we are doing like once a month some sessions so that you guys can deep dive and ask more questions. And I am recording all of this so that we can always go back to it. And then plus we always have each other to bounce off ideas. One cool thing about Madison Trust is that they actually have a lot of, they're also really focused on education, similar to what we do. And so they have an archive on like what you can do, what you cannot do, whatever loopholes or whatever, all of that information, what you imagine and think of doing. They probably have an FAQ to answer whether you can do it or not. But before we get to that route, it's more important for you guys to learn the basics of it, how it can be used, especially how things can go wrong. Because again, these are really complicated and advanced tax strategies, and you should be using it as part of your like a box of tools, but you have to know how to use it properly and when to use it and when not to use it. So the last one that we did was just an intro to self-directed IRAs. And so for me, what I learned was that you could use a self-directed IRA to invest in many, many things, not just what we can think of like, stocks and bonds, but you can do real estate, private lending, notes, syndications, metals, art, and all these other things. And there other benefits I learned is that you don't have to do a 1031 exchange if you're using a self-directed IRA because profits grow tax deferred already. And you can do private deals and you can pair with non-recourse loans. And so there's just so many things you can do. Pretty much that was all I learned was, can you do this? Yes. Can you do this? Yes. Of, how you can actually invest in. So, but now we're getting to part two is to learn about what you cannot do. So I rather for us is to learn things carefully so that we don't break these tax laws, because sometimes if you double up on tax things like tax saving rule plus you try to combine it with another one, two positives don't always end up positive. So let's learn how to be careful on what we cannot do, because last time we did learn some of the basics for the real estate is that you can't use it for personal benefit, like renting the property to yourself or your family members. So I'm gonna hand it back over to Dana to teach us more on how we can be careful about using self-directed IRAs.
Amazing. Thank you so much, my beautiful friend. I am going to share my screen, guys. Give me one moment. Let me see if I got this right. If you guys see anything on my screen, don't look. Okay. Slideshow. Again, can you guys see my slides? Yeah, perfect. So Annie, thank you so much for that recap. Last month, Annie and I both were a little stranded in Texas. We couldn't make it. But the month before, we discussed a little bit about self-directed IRAs and what a self-directed IRA is. Because we all have IRAs at Fidelity. I myself have one with Fidelity, Charles Schwab, thank God, right? But there's such things you can and cannot do. For instance, with my Fidelity, I can only do stocks and bonds. I can't invest into real estate. But with my self-directed with Madison, I can invest into real estate, precious metals. And like Annie said, I got clients investing into Arabian racehorses and yachts and marinas. Like they come up with all sorts of crazy stuff. But in my time in this industry, and now it's going over 6+ years, what I see is people don't know the do's and the don'ts because they think, oh my God, I can do all of this. And they realize they can't, there are certain things they can't do. And then at the end of it, they lose all of that gains, the profits, the savings, their retirement money, because the whole point of an IRA is the tax advantage. So I love that the Sarah community, Annie here, wants to educate everyone on the things they should look out for, because we're not scratching the surface, like she said. We are going beyond that. We want to know exactly what can we do, what we can't do. And everyone here is pretty young. So that means you guys being equipped with this knowledge only helps you enhance your wealth even more. And beyond that, help your investors, because I know, I just feel it. There are some syndicators here. There are some, we have some GPs here that are trying to raise capital through their investors, and self-directed IRAs could be that avenue for them. Feel free, guys, to unmute yourself and ask questions as we go through this presentations, because I would love to have an interactive session so it's not me just talking all the time. So real quick, we're all familiar with self-directed IRAs, yes? I see some heads nodding. Perfect. So quick recap, a self-directed IRA is an IRA where you get to utilize your retirement money to go beyond Wall Street to invest into alternative investments. But you can't do this at your traditional brokerages like Charles Schwab and Fidelity because they're brokerages. They can only do Wall Street products, or what I call traditional securities. You have to work with the special custodian like Madison Trust, moi, where we are actually a platform set up where we can let our investors invest into what they prefer. The differentiator is we don't tell you what to invest in. You get to decide. So if you want to purchase that property, you have full freedom to purchase that property using your self-directed IRA, and we're going to help you make that happen. But as with everything, right, especially with the IRS, there are certain guardrails that they put into place. And one of the guardrails is something called prohibited transactions. So IRS code 408. This might be a little more information, guys, but I always love to share in case anyone wants to research on their own, right? So IRS code 408 provides the information of retirement accounts, individual retirement accounts. Under that, there is 4975 IRS code 4975. That is basically the code that provides the things that you cannot do with your IRA. And this goes for also your IRAs at other institutions, brokerages. This is not just for self-directed. This is overall in general retirement regulations for everything. Prohibited transactions sounds really scary, right? And the truth is, it's not scary if you know what it is and how to avoid it. The most common misconception of prohibited transaction is people think, oh, prohibited transactions means I cannot invest in a certain investment. For instance, our last session, I said there's 3 things that the IRS doesn't allow an IRA to invest in. Anyone remember? I'm not gonna like put you guys on the spot, but just in case anyone remembers, do we? No, it's okay, guys. What are the 3 things the IRS doesn't let you invest in? The 3 investment types.
Insurance?
Yes, insurance is one. Well done. Life insurance is one. Anyone else? I see you thinking. So collectibles and S corporations. So 3 things that, and of course, anything federally illegal. So, and if any of y'all are thinking about, like, say, cannabis farms, let me tell you right now, federally illegal. Because I have clients who come to me be like, Donna, I got the cannabis farm fund for life. I'm like, sorry, honey, not gonna happen. Anything federally illegal is illegal. However, investing in that is not a prohibited transaction. Those are what we call disallowed investments. So the IRS specifically disallows those investments for certain reasons, right? Prohibited transactions are a little different. Prohibited transactions are when your IRA transact with certain individuals that the IRS considered disqualified. And disqualified is such an interesting word because, let me tell you, you yourself is considered a disqualified individual to your IRA. Yeah, make sense, right? So you as the IRA account holder is disqualified to your IRA. That means you yourself can't transact with that IRA. There needs to be guardrails. Your spouse is disqualified. And the next slide, I'm actually going to show you who is disqualified and who is not, especially in your family tree. But prohibited transactions are when you are transacting with a person. Let's take a real estate transaction, for instance. Your IRA cannot buy your property from your wife or husband because that's a prohibited transaction. Why? Your IRA is transacting with a disqualified individual. There are three types of prohibited transaction categories we're going to go over today. One is per se prohibited transaction. The second one is extension of credit. And then finally, self-dealing prohibited transactions. I always like to take my clients and investors through these three things because in the heat of a deal, right? The returns are great, the timing to close it's so fast, we might forget this. So I always like to bring this to their attention to be like, hey, before you try to use your retirement money, keep these things in mind, because at the end of the day, what happens is if you conduct a prohibited transaction, knowing or unknowingly, is you lose the tax advantage of your IRA. That means as of the 1st of January of that year, you lose the complete tax advantage. So first of all, everything taxes are due, okay? And all those profits and gains that you saved up, that you actually generated in your IRA no longer matter because you're going to get taxed. And the whole point of an IRA is what, guys? Tax deferred or tax free, depending on the type of IRA, right? So let's really get to know a little bit about the prohibited transactions today so we can figure out what we should and shouldn't do. So I have this really cool chart. My marketing team, a little shout out to them, created for me. So this is who can and cannot transact with your self-directed IRA. So everything in orange, guys. Hopefully I'm not colorblind because initially I thought it was red, but I think it's orange now. A little different. So those are the people that you can't transact with. But the ones in blue, you can. So let's take a look at the orange, right? First. So then there first is you yourself. So for instance, I have a self-directed IRA. I cannot do transactions with myself. So my house, if I want to purchase my house using my self-directed IRA, I cannot do it because that's a prohibited transaction because the seller is going to be me and the buyer is going to be my IRA. That doesn't work. My spouse, I cannot transact with my spouse. I cannot give a loan out to my spouse. Neither can my IRA purchase something from my spouse. My mother, my father, so my parents, my grandparents on both sides, you know, my side, my husband's side, my wife's side, doesn't work. My children, I don't have any, but if I do, disqualified. Step daughter-in-laws, actually, grandchildren's spouse. A reason why that this is a thing is because for the IRS, they want to limit the familial generational wealth accumulation. Because at some point, there is a way that all of this can be misused for generational wealth. We do want to build generational wealth, but we also want to make it a fair playing ground because IRAs are tax exempt, right? But then it's not everyone is disqualified. As you can see, the people in blue, right? So my siblings, my brother, my sister, they're not disqualified. So my IRA can transact with them. My niece, my nephew, my sister-in-law, my brother-in-law, my cousins, my aunts, on both sides, husband, wife, both sides. They're fair game. And then of course, my friends have no like familial link to me. So if you guys are friends, your IRAs are able to commingle because it's really not commingling at the end of the day. It's more business. And of course, completely unknown third party. So let's say, Andy, you decided to purchase a property. Your IRA decided to purchase a property from Danny Wong right here, and you guys don't know each other. That is not a prohibited transaction because you guys are third party strangers. Now, even if you guys were friends, that's completely fine. But if you guys were somehow related, right? And not siblings, because siblings is fine. If you were related in any other way, as you can see with the orange here, I was going to say red, that's not okay. So always keep in mind, an example I like to share is sometimes I have these instances. I literally had it this week. A father wanted to invest in their son's hedge fund. The son is the hedge fund manager, so a controlling person, and that's a no-no. So you're about to get into the fund that your son has the majority not just ownership, but control. He makes the financial decisions. That's hands down a prohibited transaction. So things to keep in mind, even outside of real estate, right? Like, oh, I see what you mean now. You can't even get into the fund because the son is a controlling person. Like the son, it might be the CEO. That's a no-no as well, because the son, who is a disqualified individual, has too much control over it. Any questions on this, guys, before I move on? Perfect. So I have shared the slides because this is like one of those slides I feel like it's very important for us to know. In my office, I actually have a picture of this because it's so important whenever I come across a deal, a new investment, a new asset class that I review this. So feel free to use this as well, guys, especially when you're thinking, how do I use my IRA? Or how do I use my investor's IRA into my deal? This is going to be that game changer. So this is a little lesser known fact. Outside of the people in our familial, like the family tree, right? There are other people that can be considered disqualified, the additional disqualified people. And a lot of people don't think about it, but it's always good to know. So fiduciaries, so advisors, right, that provide services to the IRA. So financial advisors, for instance, they're considered disqualified too. So you want to be careful when transacting with them. I know, Annie, I know that's a crazy one, right? I'll tell you why. So financial advisors, like state fiduciaries are considered advisors, right? So any type of fiduciary. So when you are advising the IRA, you have direct control of the IRA. So if the IRA is investing with you as a financial advisor, that's a prohibited transaction. And typically, financial advisors don't have their own funds. So hear me out. Financial advisors point you or allocate your retirement portfolio or financial portfolio into other funds. They are not fund managers themselves. They are financial advisors who manage or plan your finances. So they themselves are considered disqualified because honestly, they're just an extension of yourself. Because you, as the IRA account holder, you're planning your finances too by allocating your wealth. So does the financial advisor. Typically, in my experience, I've never really seen a financial advisor misusing a client's IRA because at the end of the day, you guys are real estate professionals. You know your license is at stake. Your reputation is at stake. And with financial advisors, they are under the SEC, FINRA umbrella. They're not going to play with it. Like you are one complaint away from losing your license. But financial advisors, any fiduciaries, advisors to your IRA is disqualified. Same thing with entities. So if an entity, so LLC, partnership, corporation is owned 50% or more by a disqualified individual, it is completely disqualified to the IRA. So let's figure out an example, right? Let's say your wife owns a real estate investment firm, wife, husband, your spouse. They own it. They own like 60% of it. If the real estate investment firm has deals, commercial or residential, your IRA cannot invest in that because a disqualified individual owns over 50%. That is, your spouse owns 50% of that real estate investment firm. It could be considered a prohibited transaction. Same thing if it was your parents. Going back to the example of the hedge fund manager, right? The hedge fund manager might not own 50% of the hedge fund, but they're a controlling person and the hedge fund manager is the son. So the son is disqualified and they control all the financial decisions with the hedge fund. Doesn't work, right? So these are the things I always tell my clients to think about it because you never know. It's so easy to not know because with your personal money, your what I call taxable funds, these things don't come into play because you pay taxes. But with an IRA, the whole point of the IRA, why do we even save for IRAs, right? It's to save up on taxes. It's to generate your profits, your returns, your capital gains without taxes. So when we transact with these disqualified individuals unknowingly, we lose that advantage. So we always want to make sure. This is a fun incident. Real, by the way, guys, all the examples I'm using are very much real life examples I had to go through with my clients. A few years ago, it was a residential deal. A client bought a multifamily using their IRA. Didn't think much of it because all the paperwork, none of the paperwork, names on the paperwork matched. And of course, we don't go on to a deep background check on whoever the brokers are, the realtors are, the title company, right? Everything at a glance seemed very straightforward. Looks like they weren't disqualified individuals. The client had a lot of like back and forth with our investments team. And one day, true story, I get an email and I see the client's email signature. It's a picture. It's a man and woman on the floor of some sort with their heads next to each other, like a really strange, like upside down picture, looking very intimate, right? I'm like, okay, that's a little strange. So, okay. The client's going back and forth on a lot of things that he shouldn't be doing. So I'm telling him, hey, you can't do this. Talk to your advisor or financial professional. And finally, I gave him a call. I was like, hey, who is this person? I'm going to, not using real names, I'm going to say Jane Doe and John Doe. Like, who is, I just calling here, want to get some further clarification here. Jane Doe was your realtor, right? Yes, you paid commissions to Jane Doe using your self-directed IRA. Yes. Okay. Is Jane Doe your spouse? Yes. Ah, so is that a good thing or a bad thing? Question to the audience.
Is it because they're paying a part of the money has to be used to pay the realtor, and that's actually a spouse? There's not the issue was not the property itself, but it's because one of the line itemized it has to pay the spouse.
Oh, ding, ding, ding. So in their closing statement, they had given a nice fat commission. So the spouse was both the seller's and the buyer's realtor. Uh-huh. Yep. The spouse had a different last name, hence why it was not caught in the initial analysis, like due diligence phase. So, but the client was going so much back and forth. And at that time, I was the investments manager, right? And the client was escalating so much things. Also, guys, sometimes don't escalate things if you're doing things like this. Another like moral of the story. But when I was reviewing the email for it and just a hunch and that the signature line, I was like, this is a very strange picture. I just have a feeling about this. Let me call. This is where my job back then when I was the investment manager was very much detective work. Gave them a call. And again, I wasn't pointing fingers. I was doing a very much inquiry. Who is this? Was the commission paid? Is this the spouse? Yes, yes, yes. Ah, prohibited transaction. Unfortunately, the client had to be distributed at what we call a code 5, a prohibited transaction, where the client's penalty is like 100% taxation. It is not fun. It is absolutely not fun.
In situation, can they only be taxed on the commission part that was paid to the wife, or does the whole transaction go? Oh,
in this situation, the whole transaction got code 5'd on their end. And unfortunately, we did tell them, hey, talk to your CPA, maybe they could figure something out here. But the fact that it was a year old, this happened, they knowingly did this, that was the spouse. Because afterwards, I had multiple colorful conversations with the people, and it was very apparent that they were aware what they were doing, which is another thing, right? Doing it unknowingly is one thing. Doing it knowingly is a whole different thing. Like at that point, you're committing something that you're not supposed to be committing. Yeah, it was not great. Sometimes, Annie, to your point, there are certain transaction, and that's why like extension of credit per se and self-dealing, certain transaction, you only lose the tax advantage for the asset. Certain transaction, the whole account value completely loses the tax advantage, gets penalized as of January 1st of that year. And this was one of those. And it happens all the time because we know in real estate, right? Like the spouses would be real estate professionals that they purchase things from each other, something to avoid. It was not a pleasant situation for either of us, I'll tell you that much.
I'm just trying to imagine, like, if they could have just waived and not charged any of the commission fees. Stop
They
the
could have absolutely like not charged any of the commission fees.
That's what I would do. Like, just charge less on both sides, and like, there we go.
And that's completely acceptable. That is because at the end of the day, that only benefits the IRA, not the disqualified individual. That's actually completely acceptable. So thank you for bringing that up, Annie, because that just goes to show you there are other ways around this that's completely with regulations, right? So why mess with your retirement money? But that incident haunts me for this day because it was so strange how I found that and caught that. And I mean, I felt like I was in like a Law and Order episode a little bit, but the aftermath of that incident was not fun. It was not fun. So with that, let's get down to the 3 types of transactions. And I'm sharing examples with you guys as I go, guys, because sometimes saying it doesn't make sense. Because to me personally, until I experienced all 3 different types of transactions, nothing made sense to me. And that's why I want to go with different examples so you guys understand, oh, that's what I can't do. My spouse can't get a commission from this. I can't sell this. I can't rent this to this person. So, all right, per se. So this takes place when the IRA transacts with a disqualified person, as in my example with Jane Doe, right? You transacted with a disqualified person, paid commission to the disqualified person. What are some other examples of it? Is the IRA owner purchases property they own already? I get this question all the time. Donna, my house, can I buy my house with my retirement money? Unfortunately, no. Can I buy my spouse's house with retirement money or my parents' house? What do you guys think? No, we cannot. Fun one. Can I buy my brother's or sister's house with my retirement IRA? Yes, you can. Your siblings are non-disqualified people. What about friends? Like say Jen, you guys want to buy Jen's house. Can you guys buy it using an IRA? Jen, what do you think? She's smiling. That's a yes, guys. You can. She's giving a thumbs up. Perfect. Uh, uh, if I get mad at my brother, I can buy his house with an IRA. Yes, you can. You absolutely can. Another example, an IRA owner leases their IRA owned property to their son or daughter. This is a great example. I have had clients buy a property and they think they can rent it out at a cheaper rate to their parents or their like children. No, you cannot, because parents and children, excuse me, are disqualified individuals. So by renting it out to them, you're committing a prohibited transaction. But what you can do is you can rent it out to your siblings, your friends, your aunts, nephews, nieces, stepchildren, unknown third party like you would do with Airbnb and long-term rentals. That's completely fine. Here's another fun one. I had a client, he had a beautiful beach house, right? He used to go, and the beach house was owned by his IRA. He used to go every summer and live in his beach house. And I'm like, honey, no, you cannot, while it is your beach house, as long as it's under your IRA, you cannot use it for vacation purposes because, and we'll deal with it a little later, you're benefiting from it. You're having a nice, relaxing vacation at your IRA's expense. So that's a no-no. And then finally, individual rents their IRA-owned property to a company that they own 50% or more. Oh, I have a question. CL raised their hand. Yes, CL?
Question about, say, I rent my IRA to my brother, but my mother also lives there, but the lease agreement is under my brother's name. How would that work?
Great question, CL. So lease agreements under your brother's name completely above board. There's no problem. Your mom living in it though, while there is no paper trail, so there's really no record of this, right? It's still like, if it were to come to light, it's not good because your mom is disqualified. On the paper trail, your brother having the lease above board. So I always tell my clients, be careful, because the truth is, let's be honest, God only knows how many clients of mine are using their properties without us knowing, because there's no paper trail. It's not the fact that I would know. At the end of the day, it's if they get audited and somehow they catch it, you will get penalized. So always keep that in mind. Great question. Rule of thumb is, for me personally, I don't want to mix any disqualified individuals with my retirement investments because I don't want to take that chance. Great question.
Thank you.
Of course, amazing question. I love that. So all of the things, renting, leasing, purchasing property, all is fine if it's with qualified individuals or non-disqualified individuals or third parties. Anything other than that, guys, be careful. Don't mess with your retirement money, because this is something you don't get back on. And honestly, I always say, what's worse than the SEC is the IRS. We don't want to mess with the IRS, right? So keep that in mind. Per se is prohibited transaction that takes place when the IRA, your IRA, transact with a disqualified individual. Next one. Ooh, this is one of my favorite ones. Extension of credit. All of us, guys, we use financing for our properties, sellers financing, everything under the sun, right? And different qualified retirement plans have different ideas when it comes to credit. With an IRA, so the IRA owners can obtain financing for investment purposes. This is what we call non-recourse loans, which, by the way, Annie here, your girl is very smart. We already have another webinar scheduled just for non-recourse loans and stuff in the future. However, loans issued to the IRA, they have some very specific rules and regulations. It's not like a conventional mortgage. It's not like a conventional loan. So you want to be a little careful. Also, you cannot loan to the IRA or take a loan out of the IRA. Why I say that is 401ks, solo 401ks, you can actually take loans out of it. 401ks are a different type of qualified retirement plan, not your usual individual retirement account. While they all fall under the umbrella of retirement plans, they're different. They have different regulation governing them because their structure is different. So for an IRA, you can't take a loan out of the IRA. But you can take a loan for your investment within the IRA, but you have to be careful because it needs to be a non-recourse loan. And what is a non-recourse loan? Are anyone familiar here with what a non-recourse loan is? Have you ever dealt with one in the real estate arena? Okay, so a non-recourse loan, guys, is basically, it's like a conventional mortgage. However, a non-recourse loan doesn't go off on the IRA account holder's credit score, pay stub, financial standing, or guarantee. The only thing a non-recourse loan goes off on is, like say the property, for instance, that it is actually a profitable cash flowing property, and that is the only recourse at the point that if the loan defaults. Non-recourse loans are not provided by all financial institutions. So your credit union doesn't give non-recourse loans. Some big banks don't give non-recourse loans. There's a handful of providers for non-recourse loans. And of course, they have a little bit more tedious paperwork. and their interest rates are typically a little higher, but we do have some partners we work with for our clients for their non-recourse loan, because at the end of the day, that's another thing. You can buy property with your IRA, and if you don't have enough, you are able to get a loan, a non-recourse loan, to finance the property. You just have to adhere to the rules of the non-recourse loan. So that means you're not guaranteeing, a personal guaranteeing the loan, but your asset is. So something happens, the bank comes for the asset, not your personal property, which honestly, to me, I like the sound of that better, that I don't have to personally guarantee something. So a common example of this is an IRA owner, they want to buy a property, like say a $500,000 residential property, right? They don't have enough capital. They go to a bank, they get a loan issued to the IRA, and then me, I want to buy that loan, like I want to get that house, right? I personally guarantee this loan. The chances that the bank isn't aware that this is an IRA investment is quite high, very high. So they give me the conventional mortgage without thinking anything. However, the title, the loan documents, and everything is under the IRA's name. So now this became an extension of credit, which is a prohibited transaction. Because me personally, Donna, my personal credit score, my pay stubs, and me personally guaranteeing the loan for my IRA, which is a no. How I should have gone about this is I should have requested the bank to provide me with a non-recourse loan, right? What is a non-recourse loan? Only the property is the collateral. But let me give you another idea here for my you find real estate folks. Seller's financing. How many of us are familiar with seller's financing? I see some heads nodding. Think about this. You have a property, again, a $500,000 property. You don't want to go to the bank because the paperwork is too much. The interest rate is too high. It takes too long. We've all seen it, right? Okay. What if you can work with the seller to do a seller's deal, seller's financing deal? The seller is a non-disqualified individual. So it's me and Annie, like say my IRA and Annie. Annie and I, we're non-disqualified, right? Annie says, all right, Donna, I will sell to your IRA. I'll do a seller's financing. I'm like, great. Annie and I, we're not related. We're just friends, so third party. Wonderful. I have $200,000 in my self-directed IRA. I give Annie the $200,000. The other $300,000, Annie and my self-directed IRA, we have a promissory note. Annie says, I will do this for 3 or 5, whatever years we can decide. 5-year note at this interest rate, Donna. You paid in monthly installments, principal and interest, and at the end of 5 years, when the note is paid, the property belongs to you. Until then, for the 5 years, the collateral for this note is the property. So if you default, I get the property back. Voila, seller's financing deal. Not only was I able to purchase a property, I was able to work with the seller, that is Annie, who is a non-disqualified individual, to get financing without the complications of a loan from a bank. And there is more freedom on this. And I actually have a lot of investors who do this, because where they work with the seller, because for the seller, it's 2 things, right? For the seller, it's they really wanted to get rid of the property. They got a great price and now they got a consistent cash flow. Okay, great. But they also got a giant chunk in the front because I'm giving Annie $200,000 up front. The other $300,000 I'm going to get in 5 years plus interest. So it's not that it's $300,000. Annie and I will decide whatever the interest rate we agree on, right? It could be 7%, it could be 10%. So 300,000 plus the interest rate. So, and I get my property at a time where I'm not going to have to lose all of my cash. Win-win. I get the property in my self-directed IRA. Now, don't forget, guys, this is all in your self-directed IRA. I rent it out. If it's a multifamily, I rent it out to multiple people. My rental income will pay Annie's loan monthly. Great. And if I'm really smart, I'm going to ensure I rent this out. My net operating income, I want to be a little smart about this, right? I rent it out. So not only do I pay Annie's loan, I have a little bit left so that it goes back to my IRA, tax-free or tax deferred. I have a whole lot of clients who did this strategy where they do seller's financing with the seller, rent it out. The rental income not only pays the loan, but it also gives me a little bit of a savings in my IRA. Win-win situation. So think about that. We can't get a loan because we can't guarantee personally, but we have other creative ways to get to it. Honestly, I prefer the creative ways of sellers financing over conventional loan because at the end of the day, you all have gone through it. I've gone through it myself. It is hell hat no fury dealing with a bank to get a loan, especially right now more than ever, only to end up with them giving me a really crappy interest rate that doesn't meet my standards. I rather work with that seller to get the seller's financing. So any questions on that strategy, guys?
Probably for more of a comment than strategy is that it's harder to even qualify for a loan or finding a property that qualifies for whatever the DSCR ratio would be required to get the loan, especially if they can't use money from outside, like your own personal money. Because like if you don't have enough, hey, like maybe my mortgage is only $3,000, but and I'm like, okay, maybe I can't, my rent is not enough to cover whatever their ratio because and then normally I would just put my regular money in, like my W-2 money, but in this situation you can't. So realistically, it's really hard in this current environment to even find a deal that could probably qualify for the non-recourse loan.
I am so glad you brought that up. And Annie, because that is exactly one of those like indicators if you're going to get the non-recourse loan, right?
Yeah.
SCR, like absolutely, they're going to do underwriting on that property to figure out if it's worth giving you that loan. And then even at the end of it, you're not going to get a steal with the interest rate because the interest rate is going to be much higher than the market rate. So are you really winning?
Especially if you're buying an apartment, all that, not only the PITI and all the insurance and all that, but like I'm imagining if there were repairs or utilities, and if I can't use my other money to put that in there, I'd be screwed over regardless. So if I'm thinking like creatively and I'm doing creative financing from the owner, they probably might not even make me put down like the 30-40% down payment that's required for as if I had to go to the conventional loan. I could probably put it down less and then I have more on myself.
Exactly. And that's the thing, Annie, you're now thinking about the seller's financing the right way, right? Because the agreement is between you and the seller. There are no restrictions here. So if you talk to the seller and the seller agrees, well, I don't need a down payment, just give me a loan. Give me a note. That's it.
Right. And then plus for the seller, what they can also benefit, say if they had a lower interest rate, and right now the market, if the interest rate is like 8% or something, and then they got at 4, you can even pay them a little bit more, like this 5 or 6%, they can earn a little bit of extra from there too.
Correct. And I've had like discussions with a lot of the sellers on the other side too to get a little bit of understanding on what was your thought process here, right? I just want to know personally, why would you do this? And for them it's like, why wouldn't I? Right? I want to get rid of this property, but I would also like a cash flow. Rather than getting a giant chunk right now, it's like a perpetuity, really, more like an annuity, really. Rather than getting a giant cash flow right now, where I will have to pay, guys, don't forget, they'll have to pay taxes, capital gains. Okay. If they don't 1031 that, they pay capital gains. And if they do 1031 that, they have to buy another property or hold the money in escrow until they buy another property. They can't really utilize the money for their expenses, their personal needs, right? Versus in this case, they sell the property, they get the cash flow monthly, quarterly, however they decide. Again, they have the freedom. They have cash flow now to live.
So the strategy would be to buy this from like a mom and pop that's a little on the older side that they want to get out of real estate business, but don't want to really take the tax hit all in one go. And they might want to spread it over a couple of years, usually like some kind of balloon thing.
Correct.
Because if you're buying from another syndicator, they're gonna want like, hey, I want my money fast, or I want to do a 1031 or something and just get my down payment back out and then reinvest into elsewhere.
Exactly. And this strategy is fantastic, especially if you're buying from the mom and pops, right? And you don't want to give up your retirement money. You only want to hold on to your retirement money, make other investments, but still have the flexibility of owning real estate through a note. Because at the end of the day, the asset in your IRA is a note that once you're done paying and it matures, you have the property. But you already rented it out. It's already cash flowing. And that's why I said, be smart about it, right? When you rent it out, don't rent it out to break even with the loan amount. You rent it out to pay for the loan, to pay for the expenses, and you have a little bit of, even if it's a few $100s left. And trust me, it's absolutely possible. So I love that. Annie, thank you so much for that. I love hearing it from the real estate professionals' point of view, because it's like, this makes sense, right? Mind blowing. Any questions here, guys, before we move on to our third and final prohibited transaction? Yes, CL.
So this question is actually very elementary. So where can you invest that, say, 500 extra? Like it's little. And where do you put it?
I love that you asked that. So for something as small as $500, what I've seen people do is precious metals, right? Silver, it's between $35 to $45 an ounce. So, and gold, yes, it's over $4,000, but then there's other coins, right? Palladium, Canadian maple leaves, eagles. So a lot of the smaller amounts, I have seen people invest in precious metals, especially when they are considering a recessionary time or a time of high inflation oncoming. So if you're never sure where can I put my $500, there's always precious metals. On top of that, now there's crypto. So you can invest in crypto. So your $500 could be invested in smaller crypto coins, other like XRP, for instance, right? Like I forgot how much XRP is, right? It's like $2 something right now. There we go. You can invest your $500 on that.
Would you
Yes, Andy?
sorry, would you recommend that when there is a fee per transactions?
So for us, how we do crypto is we don't hold crypto directly. Our clients set up something called an LLC, a checkbook model in their IRA. So with that, they can set up an account with Coinbase or Kraken and trade themselves. We actually do not take any percentage of the trades or charge for the trades.
Okay, I was talking about the gold and silver, but okay.
Oh, for the gold and silver, like you mean for trading?
Yeah, for like buying gold, buying silver.
So the trading cost is actually not that much at all, like purchasing gold. So we work with Delaware Depository, and their sister companies Fidelity. So I actually have clients who do invest $500 to $1,000 to $2,000, like purchase metals with them at minimal cost. And it's absolutely worth it because over the span, just like the stock market, guys, right? Like if you look at the stock market for the last 25 years, while there are dips, in general, the stock market goes up, very similar to gold, very similar with precious metals, especially now. Silver and gold have broken records, and we're kind of looking at a recessionary period next year or speculating a recessionary period. A lot of people are like hoarding gold, precious metals. So, Andy, I would suggest take a look at the Delaware Depository and have a conversation with them. You'd be really surprised. Perfect. Great questions, guys. Thank you, Andy. Thank you, CL. CL, did that help answer your question?
Dana,
Hey,
hello?
Cherry.
Yes,
Yes.
thank you.
It's actually Drew. I used my
Oh,
voice
Drew.
account. Hey, so I want to follow up on that crypto
Oh.
self-directed IRA to invest in crypto, specifically XRP. So and I was thinking of Coinbase. So do I just set up an account with them and then transfer it from my self-directed IRA into that and then purchase?
So your question is, how do you set up an account with Coinbase for your self-directed IRA, right?
Yes.
Perfect. So you set up your self-directed IRA, Drew, and within the self-directed IRA, we actually help you. We have a sister company who sets up something called a checkbook control model, which is an LLC, a limited liability company with a checking account. So once that is set, it does have an additional cost, but it's a one-time cost. Once you have it, you can invest multiple assets using that LLC model. So imagine this, you have your own LLC within your IRA. So you can conduct a business within your IRA. So you have your self-directed IRA, Drew. Underneath it, you have your, let's say, Drew 123 LLC with its checking account. Once we transfer the money from your IRA into your checking account, you can set up a Coinbase account under the name of your checking account, transfer the money to your Coinbase account and trade whatever coins that you may please, if it's XRP, Bitcoin, Ether, you name it. And because you are the non-compensated manager of the LLC, you have the privileges and the power to trade on behalf of the LLC. The LLC and the Coinbase account under the LLC is still protected, tax advantage and protected, because at the end of the day, everything belongs to your IRA. The only thing is you cannot take any of the coins out for yourself personally. You have to request the distribution from your IRA custodian, but absolutely possible.
Perfect. Where do you have a link where I can, that's actually a lot of information that for me to, I can kind of understand all that, but is there a way I can, a link where I can get that information, or do I just
Don't
go to
worry.
Coinbase?
Don't worry, I will send you like all of this and Dana's contact information, and so I'll do that afterward.
Okay, perfect. Yeah, because I'm driving and then trying to listen to all that, and I was not able to like write down.
That's I'm here for, and that's what AI Zoom is for. I got
All
you.
right, perfect. Perfect. Thank you so much. It's a lot clearer for me now.
Absolutely, Drew. Absolutely. And feel free to get in touch with me. I'll get you in touch with one of my best guys for LLCs, because it's a lot of information, right, guys? You're hearing about LLCs and IRA. You're like, what the hell is all of this? So we'll be happy to educate you guys and answer any questions you guys have. So if you are setting it up and using your IRA to do this, you'll do that with the most educated decision. And it's not like, well, I have no idea what I'm doing, I want to set it up. And our site, madisontrust.com, we have a lot of information.
Perfect. Now, and can I, sorry. I also want to like set up one that using cash, so then I don't have to wait until 63 or whatever to use my retirement. And that's also can be set up with the LLC as well.
So when you say set up something with cash, Drew, what do you mean?
Yeah, like pre-tax dollars, as opposed to use my retirement account to purchase the crypto.
So that's different, right? You can do that right now. Because
right, can I use the LLC to do that?
So we typically don't recommend using the same LLC to do that, because again, disqualified individuals, you're disqualified to your LLC that's owned by the IRA. So that is considered commingling. So what I would suggest is the LLC for your IRA is separate from your LLC for yourself. It's always better not to commingle, because you never know, right? Especially with crypto, what is what gain is what. Keep it very separate.
Okay. Perfect. Thank you.
Of course. Great questions, guys. All righty. And then the last one, last transaction. I know we are a little over, Annie, so I'm going to wrap it up real quick. Self-dealing prohibited transactions. So we spoke about this a little bit too, guys. Self-dealing is you guys. Oh, did I get stuck a little bit? Can you guys hear me still?
Yep, you're good.
Okay, perfect. I'm a little stuck in a very unflattering pose on my picture right now, but it's all good. So self-dealing transactions, guys, is what we discussed. Your self-directed IRA bought a vacation property and you use it during the summer to have a vacation. That is considered a self-dealing because you're personally benefiting. And typically with the IRS, they do not want you to personally benefit from your IRA investment. Same thing if you're working at a company, let's say, right? You're working at a real estate investment firm. Your IRA invested into the firm, and because your IRA invested into the firm, you get a bonus. That's a prohibited transaction. Again, self-dealing. a disqualified individual cannot personally benefit from their IRA's investments. I always tell my clients, don't even bother going in and changing a light bulb in your house if it's going to give you a penalty. Unless, of course, the LLC model alleviates a little bit of these prohibited transactions, a little bit, not too much, but don't mess with anything that could end up showing that you self-dealed, that ended up being a prohibited transaction, because why would you want to, right? And I love the question that Drew asked there, right? Can I also use my taxable money in my IRA LLC to invest into crypto? Well, if you do that, there is a chance that you might self-deal, right? You might personally benefit from the crypto investment from your self-directed IRA, and that could end up penalizing you, which is going to be a problem. So 3 transactions per se, extension of credit, and self-dealing. Anytime you guys are looking at an investment, think about that a little bit, and then take a look at the disqualified individuals, the family tree that I have, because you want to be sure. You never want to do something that might put you in a situation like, oh, I can't undo this because now this is years and years of work that is down the drain. Again, going back to my client, his wife, spouse, was the realtor, sellers and buyers side, got the commission. There's a very clear paper trail. That is not something that you can argue with the IRS on. That is not something you can tell the IRS that didn't happen. It did, and it shows, and it's recorded. So you always want to be careful, but I'm not saying all this to scare you guys. The reason I like, and the reason Annie and I wanted to share this information with you is there's so many things, guys, that you can do with your self-directed IRAs. Like today we learned even $500 investments can be invested into precious metals, right? You could buy property even if you don't have money and you just have a few $1,000 and do seller's financing with your IRA. There's so much things you can do, but always remember, understand the things you can't do, disqualified individuals, prohibited transactions, so that you're not penalizing your IRA and your hard-earned retirement money and capital gains, because especially if it's a Roth IRA, that's tax-free money. You don't want to mess with that. With that, I know I took up a lot of your time today because Donna was out gallivanting in New York City and was very late to come to the webinar. But here's my contact information that Annie will absolutely share with you. I also have my Senior Strategic Relations Executive too to help out. If you guys have any questions at all, just even have a scenario you guys want to run through me, please shoot me an email, like set up a time to chat, because I love assisting people with their unique and creative situations. But even more than that, I love being a part of the SARE community and helping you guys be the best real estate professionals and investors you guys can. So before we wrap up, I'd love to know if you guys have any questions.
I have to say, this one was harder than I thought it would be. Like, it requires a lot more brain power.
I know.
You could see my mind had to be spinning. Like, let me think how I can get out of this loophole or this issue.
I'll tell you this, Annie. Yes, this one takes a lot of like brain power, but that's why I was trying to give like examples as I go. But guys, if you have a situation and you think it's impossible, it's not. Give me a call, give me an email. I am sure if you sit down and really look at the whole picture, we can find a loophole. And honestly, at the end of the day, it's not a loophole. It's actually an IRS approved strategy that people are just unaware of.
Right, and it's just how we have to be a little creative, like how we just came up with, like, they came up with the situation earlier to you about the commission, there would have been ways to fix it, but they have to be honest and bring it up early.
Correct. And honestly, like say it was an honest mistake, right? You can undo it. It's an honest mistake. Okay, perfect. Work with the title company. Provide the commissions back. Let the commissions go back to the IRA. Have your CPA get familiar with this and have them write a letter to the IRS informing them of this beforehand. So you covered your bases. hey, this happened unknowingly, everything has been undone. Something else that I wanted to share with you guys today before I wrap it up is there are certain situations, certain things. I always ask for an attorney letter. For instance, the hedge fund thing, Henny, remember how the father wanted to invest with the son's hedge fund, but the son's a controlling partner in the hedge fund. I always say, if an attorney well-versed in ERISA, that's retirement regulation, can review the structure and say, this is fine, like upon my review, this does not constitute for a prohibited transaction, basically bless the mess, you might be able to do it. And that's another thing. IRS opinions are subjective. They're not objective. I've seen many opinion letters with the IRS on the same, very similar situations provide different verdicts. So it really is a matter of who is reading the regulation in what way and how can they provide the evidence to back it up.
That's right. Cool. And final questions for you is, wow, it sounds awesome. How much does something like this cost to get set up with the SDIRA and also the checkbook balance?
Oh, I love this question. So let's talk about the SDIRA portion, right? So Madison Trust, I am so proud of this, and this is why I love working with this company. It's a flat rated fee. It's $440 a year, charged $110 a quarter. Everything else is transactional. It's like $50 to sign up, $50 to invest, $25 incoming and outgoing wire fee, and no portfolio charge. So you could have a $50,000 investment, it could get to $100,000. The value remains the same. And of course, because of the SARE community, we are waiving off all of the startup fees. And for the rest of the year, it's basically free if you sign up with Madison Trust for your self-directed IRA needs. Again, thank Annie for that. I think she'll like a bottle of wine at the end of the year for Christmas. I don't know, guys. She just said that, not me. For the LLC portion, we have our sister company that does LLCs. They set up your LLCs, the operating agreement with the proper IRS verbiage and legislation, legalese, EIN, and articles of organization, and in any of the 50 states. So you can set up an LLC in any 50 states. We'll handle all the paperwork. There is a one-time cost of $12.95, but again, for SARE community, we are discounting that for $9.95. And the checking account, we all work with Titan Bank based out of Dallas, Texas. We also set up the checking account, and here's the great thing about the checking account is minimal fees. There is barely any wire fees, transfer fees, or minimum balance fees, and they are what we call a very IRA LLC friendly bank. So for those of us who want to transact with, like, say, crypto, precious metals, and other things, having a bank that understands an LLC model is very helpful.
Great. And feedback for folks that are in here. Again, this is not a sales pitch. I am not getting paid for all of this, but as I was doing my research on SDIRA, Madison Trust did a lot better in terms of pricing compared to the other companies. And especially because they have a flat fee versus the other ones, it would get higher as you put more money in there. So that was something that I thought was really interesting. And also, like, the pricing of their LLC setup, it's actually a couple $100 cheaper than the other ones. And I wanted to see if you can explain to them, like, how is it possible that you guys are able to manage like significantly lower fees than some of the big names that we might have heard of as well?
I love that you did your research, Annie. I expect nothing else from you. You are the queen of research. And yes, guys, Annie does not even want anything for any of this. Like, honestly, like, I owe her dinner or something here, because she's doing this out of the kindness of her heart, just to educate all of the real estate professionals out there. The reason why, and everyone asks this from us, how are we so cheap, right, Donna? How do you make money from $440 a year? Because we are a volume-based business rather than a portfolio-based business. We have 20,000, actually over 20,000 clients at this time. And we have hundreds of transactions a day, and we are growing rapidly. We've been in the business for 11 years. We are standing strong. We are one of the best custodians out there in the market. And because of our loyal customer base, the retention rate with our customers is 95%. So once you sign up with Madison, you're a lifer. And that's not because of the cheap flat rated fee, but it's also because of the customer service. And it adds up, Annie. It really does add up, 20,000 clients. And of course, we have about over $5 billion worth of assets under custody too, ranging from real estate to private equity to precious metals to my favorite clients, Arabian racehorses.
And then, so if everything is streamlined, will I be working with robots or people from India?
I'm sorry?
I mean, like, again, what the pricing is to keep it low with all the volume, but will I be expecting, like, I'm making a phone call to some third world country, the Philippines or India for service?
So, great question. I'm very proud of this, and so are the partners at Madison Trust. So one, Madison Trust is basically a family-owned business, privately owned. We have zero debt, which is kind of unheard of in this market, owned by 3 partners. And the whole reason Madison Trust was born is one of the 3 partners had a account, their mom's account with one of our competitors, and the customer service was atrocious. So he walked out of there saying, I can do this better. And that is exactly what happened. To this day, and for honestly, forever, Madison Trust customer support team and all teams will be strictly US based. When you call Madison Trust, you will always get a US based representative, and you will always get a self-directed IRA certified representative, including myself, by the way. That's my direct number. That's my direct email. To this day, I have clients from back in the day. I used to be a support rep, by the way, at Madison 6 years ago. So to this day, I get my clients calling me, be like, Donna, I know you're not a support rep anymore, but please help me. And I'm like, all right, Joe, what you need. So every time you call, you always get somebody. And let's say it's busy season, right? We are about to Q4 year end. If you get a voicemail, please leave a voicemail. You will get a response back within 24 hours. And that's something we are really proud of. We are very much customer centric, and we pride ourselves in our customer service. If you guys don't believe me, take a look at our reviews.
And I bet he has no social life.
Oh yeah, guys, sorry. Personal life, social life is gone. Like, I am in the East Coast right now. Like, it is 10:25, guys. I have had a full-on 16-hour work day right now.
I hope they pay you double. Like,
oh, yes, CL, I see you raised your hand.
So this is very complicated, like, with a lot of like knowledge base, right? So when we were to make a transaction, who is there to help us through? Is that the rep, or you mentioned a support rep to help us through that transaction, making sure there's no, unprohibited transaction is involved, that sort of thing?
Great question. So yes, we have a great support team to help you out with any questions you have. Anytime you want to just, confirm if what you're doing is above board, give us a call. We'll have to walk you through it. On top of that, when you set up your Madison Trust account, we have a lot of individuals helping you. One is your account executive. They'll sit down and talk to you before you even set up your Madison Trust account to understand, what are you trying to do? Is it possible? What do we need from our end? To review, like real estate, right? We'll need the HUD, purchase contract, draft of the deed, all that fun stuff. Our investments team will review it. If anything is wrong, before we send any money out to title or escrow, we'll talk with you, give you a heads up. We'll work with your title company to ensure everything is properly titled. Everything is properly under the name of your self-directed IRA and not your personal name. We will check this and work with you up until the very moment we send the money out to purchase your property, so we know everything is above board. And of course, let's say something happened, right? Like something happened in between and somebody, whether it was you or us, we didn't catch it. We will work with you to rectify it, because it was an unknown mistake, an unknowingly mistake that happened. Our compliance team will work with you. What I do suggest, CL, because again, a lot of information, right? First things first, don't even set up an account. Just talk to one of our account executives about what your situation is, what you want to achieve. Walk through the whole process on how it works. Ask as many questions as you have. And even then, don't set up. Wait. do your research, see if this is the right fit for you. I always say, as much as I would like everyone to be my client, some people it might not be a good fit. Come back after your research, answer any final questions, and then set up. This is your retirement money. Protecting is more important for us than having a bunch of clients that are doing things that they shouldn't be doing and destroying their retirement money. So if ever in doubt, give us a call, set up a call, let's talk through it.
That and watch all of these webinars before you make any single move. Seriously, because I think my word was the same as Jerry's. It's like how if it's so detailed, you don't even know that you're making a mistake. And it's like, how will someone else be able to figure it out that we've made a mistake? Like, there's so many questions to have to ask.
There is so many questions, and that's the thing. You gotta sometimes first set up that initial call, right? Walk through the process, understand the company, who are you working with, what's your investment, whether it'll work for you. Do your research, ask the final questions, and once you set everything up, there is always going to be someone there along with you. And even then, Annie, to your point, if something happens, don't be afraid. Let us know. Because our whole point is that's when we get our compliance teams involved. Hey, we have a client. They accidentally did X, Y, and Z. What can we do here? We've never had a situation other than the client I mentioned before with his wife being the realtor. The only problem there is while we were trying to work with the client to undo it, he was very non-cooperative. And we had no choice but to be like, okay, there's only so much we can do here. So yes, in the beginning, it's complicated, but once you do your first deal through your self-directed IRA, it's really not that complicated because it's like anything in life, like learning to ride a bike, guys, little by little, we do it. But also watch the webinars, ask the questions, and again, a lot of resources on our site, guys. It is literally an encyclopedia for self-directed IRAs.
Yep. All right. So if you guys have more questions, we'll save it for the next one. We do this is a series, so this is only part 2. We're going to have 4 more episodes coming up all the way until March, and we'll be sharing these videos out and plus our notes and everything as we go through, so we can learn more together and ask more difficult questions next time. But don't worry if you guys couldn't catch everything. I do have the slides, so I will be sending those out to you along with the video. And yes, oh my God, the discount. I didn't even know about the second discount on the LLC one. Last time it was just on the free account setup part. I was like, whoa.
Guys, Annie, I'm gonna hook you guys up.
And like, who decided to use $440? Because don't you know it means to die? And the number 4 is to die in Asian number. So it's like, no, we got to change those. And I know Jerry's like laughing. That's how my brain works. All right, so thank you guys for sticking around tonight. Give me until maybe Friday or so, but I will send all these things out to you guys and trim our goofiness in the beginning out. So
Please do, because I do not want to be a fugitive with all of my rule breaking in the beginning.
none of those silly things are getting. All right, so catch you guys later. See you guys next month.
Have a good night, everyone.
Thank you.
You.